Bill Baruch, president of Blue Line Futures, is back with us. We'll be discussing the Fed meeting minutes today and his outlook for commodities and metals. Welcome back to the show, Bill.
Thanks for having me again. It's always a pleasure to join you.
Always a pleasure to have you, and thank you for being on the show. You're here to kick off our coverage. You're one of my first interviews of 2023, and one of the first pieces of news of the year is the meeting minutes from the Federal Reserve that came out earlier this afternoon. I'm just going to read a paragraph from the summary here. Participants generally observed that a restrictive policy stance would need to be maintained until the incoming data provided confidence that inflation was on a sustained downward path towards 2%, which was likely to take some time. In view of the persistent and unacceptably high level of inflation, several participants commented that historical experience cautioned against prematurely loosening monetary policy. So it seems to me that the Federal Reserve has acknowledged that inflation is still unacceptably high, and they're not about to loosen monetary policies anytime soon. Market reaction to this, your take?
We've seen a little bit of a little selling, and then it's kind of buoyed back. I think this sort of, your comments and reading that actually, really kind of set up what I think is going to happen over the next 30 days or so. I think that we've seen some economic data show deterioration. We've seen inflation come down. I mean, ISM manufacturing prices today contracted at 39, which is the sharpest month contraction since the start of the pandemic. And so there's signs here that inflation is coming in. And then I think coupled with the deterioration of some of the economic growth, we'll get non-farm payroll this week, ISM non-manufacturing this week. I think there's a good chance we don't see the Fed hike at all in February. And here's the thing is as you described their minutes there, they cannot, and I don't really call it a pivot by not hiking, but for loosely it's called a pivot. They cannot pivot until the exact moment that they are ready to pivot. And that would be I think they kind of hold this hard ground that there's still more work to do. And then we could see something from them surprise the markets come the first week of February.
Surprise the markets. I mean, the markets seem to be not taking it great. The stock markets I'm looking at right now actually slid following the 2 p.m. release. It's down a little bit since 2 p.m. Gold is up slightly on the day, but, I think if I can interpret market reaction correctly, it seems to be lukewarm. People are either shrugging it off or not taking this as great news. And well, why would they, right? But the Fed's basically announced that they're going to stay restrictive for a while. How would you trade? So how would you trade going into the next couple of months is my question.
Yeah, I mean, I think we're starting to see before the minutes something very interesting. This is a couple of hours or before the minutes, middle of the morning here. The yen started selling off pretty sharply, and I think that's interesting. That you can't ignore that. With the yen going, silver sort of followed. Gold's about 1% off the highs, but silver's down more than 1% on the session and below $24. It's down on the week, I think now. And I wouldn't be surprised to see the dollar. It seems like it's ready to move up a little bit. The euro is longs, and the euro is, I think, it's one of the most crowded trades in decades in the euro. Or in a decade. So I think we're looking at potentially the currencies are going to be the most important mover, because if the dollar really rallies, it's going to pressure equity markets, pressure metals, pressure commodities in general. And you know what? And that would really kind of buoy rates a bit too. So if that plays out over the coming weeks, I think the Fed sort of gets tighter financial conditions even before, and that also would encourage them not to hike in February. So I would look coming out of that as if they don't hike or seem much less hawkish, less hawkish. I think that could be a big leader to a risk-on rally for the first half of the year.
So the surprise you were talking about in February is a risk-on surprise.
Yes, a risk-on surprise and potentially no rate hike at all. I'm looking at that would we got to see this sort of situation lay up into that, but that would be an ideal situation for the way I'm looking to play the markets. But again, the market, you got to do what the market tells you, and the market's always right. So forecasting is always fun, but at the end of the day, you got to trade the market you have, not the one you want.
I'm going to give you a statement, and please, evaluate it, disagree, agree. The Federal Reserve needs to straight up pivot, not just keep rates at an elevated level without hiking, but they need to reverse course before another sustained bull market takes place. In other words, Bill, even if they don't raise rates after February, markets will still be in a bear market. Agree or disagree?
That's tough. I think there's a lot of factors there. It's not going to be a bear market. I think the markets could really capitalize off that. The real question, if we're going to talk about equities, is going to be earnings. And I'm not that negative on earnings. I really am not. And I think one of the greatest examples here, they may write textbooks on this, is Micron. Micron, I've been talking about this story for the last couple of days, also to clients at the end of last week. So, and ironically, Micron happens to be up 8% today, maybe 7 after this FOMC minutes. But Micron, you look back, trailing 12-month earnings, PE 7 or 9. Now forward 12 months is negative 100. They've written down revenue expectations. They've called for layoffs, and they're doing everything they can to really lower the expectations. And they reported earnings 2 weeks ago. Guess what happened? Stock really didn't go down. It was not a good report. They missed earnings estimates, but the groundwork was already laid. What did happen was the rest of the chip sector sold off pretty hard. So I think there may be some stocks, some companies that haven't done what Micron did, and those could get really hurt in sort of through earnings season. But I'm actually really upbeat for the companies that got ahead of it. And I think that could really lay the groundwork. If you're a stock picker, could be a really great stock picker's market. And if the Fed doesn't hike rates, you've got some really, really terrific tailwinds. Because I think if you're a CEO and you had 2022 to take advantage of it, you're cutting your costs, it means layoffs, you get yourself in a good position, and then you hop over the lower bar.
Mm-hmm. I'm going to give you another statement here. Now, agree, disagree. The market sell-off that we've seen over the last year, all throughout 2022, was not caused solely by the Federal Reserve tightening rates. And the reason I say that is because if you look at the last 2 rate hike cycles, from 2016 to 2019, and from 2005 all the way to 2007, those rate hikes saw bull rallies. So the Fed was raising rates aggressively for that time, and the stock market still did quite well. So we can't blame the Fed for what happened this year. Agree or disagree?
I disagree there. I mean, if you look at it from where we were at 0. And these hikes, these were aggressive. These were just aggressive. You look at it as sort of a percentage type move, and from where we were, this was a very aggressive hike. And also in the face of inflation, in the face of a slowing economy, there was clear signs at the end of 2021 that the economy was ready to slow. So I think that there was a lot of factors here, but with the Fed really hiking those rates through that's what slam dunked this market down.
All right. So looking ahead, then, give us your top 3 investment risks for 2023 that you're watching out for.
Not using Blue Line Capital. I mean,
that is a risk.
That's an investment risk. It's going to be a volatile market. It really is going to be a volatile market in the securities. Blue Line Futures is terrific with commodities, and having somebody to lean on. Obviously, not having somebody to lean on is an investment risk. But ultimately, it's going to be a very, very choppy market, very volatile market, and we're very aware and protect downside as a portfolio manager. So I think there's going to be a two-way trade at times. I think the market could really, really rally very, very sharply to start the year. But but a lot of those managers, I think that are going to start, maybe sitting at 50% cash right now and start allocating it at higher levels. So I think the real investment risk is not being invested right now and not protecting your downside while this uncertainty is going on. And so that's an investment risk. I think, ignoring what could be a reemergence in inflation in the second half of the year, it would be a potential reinvestment risk or an investment risk. And then, I just think, being out of the market in general right now, not being invested, is an investment risk as well. I think we've seen this. The S&P is down 20%, and at this point, you've really almost never seen a market 12, 18 months out not be significantly higher. You combine that with the midterms, in the midterm elections, you go back to 1950, the market's never been has never been not higher, or it's since 6 months out and 12 months out. So I think there's it's a lot of, it's a tough question to answer, but I think if you look at it as not managing your risk properly, not looking at the ebbs and flows of inflation that are going to control policy, and not being invested.
somebody hedge? How would you recommend someone hedge against some of these risks that you're talking about into 2023?
Well, it's not everybody has the expertise to do that. I mean, there's simple strategies to use in options to hedge your downside.
Well, tell us about some of the ways you're hedging. Yeah, blue line futures.
Yeah, I mean, for instance, right now, I mean, we're at weight or equal weight in technology right now, but we're using some QQQ puts to get through what was the end of last year and through the start of this year, and see how things start off. So rather than being underweight technology in general, I mean, it could be something that I mean, you've already seen Apple really sell off sharply. We don't own Tesla, but you see a lot of these stocks the past 30 days really sell off sharply. So one of the ways we hedge is we're using put structures in the Qs to take advantage of that. Obviously there's ways to do it on the future side too, but that'd be the most simple way. Where are you overweight? I mean, we're very overweight energy. We've been up to 20% energy in our portfolio at points last year. On top of that, layered with additional energy. So like there's a bucket that we pick stocks in, that was 20% energy. And then the portfolio as a whole also had midstream energy exposure. So we've done really well there. We're very overweight. We've reduced that 20% down to about 11, but we're also, very, very cheap expenditure on some put protection in XLE in case, I don't want to underperform because of energy rolling over, though I still like energy and I like the cash flow there.
Okay. I was going to ask you about your trades, but you've answered that. So let's move on to the final question. Top commodities or assets. I'm going to actually expand that to any asset. You can talk about commodities, you can talk about stocks, but basically your top 3 long positions of the year.
I love the metals. Ironically, I bought in my commodity fund. I've bought puts in silver yesterday. But I actually really like gold and silver. I think you got a very good seasonal tailwind here that's building up. That's one of the reasons why they've performed over the last few weeks. Very seasonally bullish time of year. Statistically speaking, if you bought silver around like this December 20th and held it through the second week of February, you've made money 14 of the last 15 years, averaging about $1.50. Gold, if you bought December 23rd and held it, through the second week of January, you've made money 14 of the last 15 years, averaging about a $31 move in gold. So I think there's a lot of seasonal tailwinds, and then later in, I think you get the Fed to back off and pivot, if you will. Then I think that brings a tremendous tailwind to the metals. But I want to be, I think there's risk in the dollar rallying in the near term. The euro is very loaded position right now. So I'd like to see a better spot to re-enter those trades. Okay. I think they'll have great 2023.
All right. Final question. I'll let you go. In 1 minute or less, give us your top sort of advice to young investors out there looking to start trading, mistakes that they should avoid making, lessons that you've learned in your past that they should emulate. Go.
Get in. I mean, it's never too late to start investing, start trading. I would say don't think you're a trader. Know what you're doing. Don't just start doing options. But I think the risk is just not being involved in the market, not investing. I mean, there's ways to simply do it. Just buy ETFs mimicking the S&P 500. This is a tremendous time. I mean, you look at the S&P down 20%, and if you're a young investor right now, this is a dream come true in many sense. I mean, even if we go to 5-10% lower, I mean, this is a dream come true. This is an opportunity of a lifetime to be able to start investing in the market over the long run. I'm talking about somebody with the 20-year, 30-year time horizon.
Mm-hmm. Perfect. Yeah, good discount, good entry point. Thank you, Bill, for coming on the show today, and thank you for coming on Kitco and spending time with us all these years. You've enriched our audience. I appreciate your work, and I appreciate you being on here. Thank you.
Thank you. It's a pleasure. Thank you.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more. Don't forget to subscribe to our YouTube channel.